Hi, I'm Mark Rosanno, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and we have some interesting things to talk about with additional shifts that are coming from Russian flows, how that's impacting the market, especially when you look at India and China. And then when we look at some of the additional flows, India for the most part, as well as China, has actually been buying much less, especially India, from multiple places throughout not only just the Middle East, but also West Africa and even the US, which is again creating some additional issues in terms of volumes that remain in the ocean. And those are some of the key pieces that we want to look at, because now as Russian product comes into the mix, how is that going to adjust some of the storage situations and some of the margins that we've seen? And that's why, it's kind of a broken record when we say this, but it's going to all be about the middle distillate crack. I mean, that's where it's going to end all and be all. Where is the middle distillate crack? And if that weakens to a level, you're going to get a fairly sizable drop in terms of just run rates, and then that will bring down underlying demand. But then, as we've talked about, even if demand comes down, you still have OPEC producing well below quota. You still have issues coming out of Russian flows in terms of just volumes. So that's where we keep having this standoff, which is why we still hold to the fact that we have this range. We don't believe we're going to shake out of it here. And then what is going to happen when we go into the summer months? And that's where we think we're starting to see some cracks in terms of what some of the demand cycles could look like. But it's going to be important to keep track of that as we progress through the year. So when we look at this first segment, we're going to look at oil product stockpiles rising globally, and how product stockpiles is going to become a much bigger issue, and what does that mean for the U.S. Then we're going to look at the U.S. and look at demand strengthening and how it strengthened on the back of gasoline. But that number is a bit overstated, so we want to look at where that's going to drop down to. And then we want to look at, again, Russian product and how that is shifting the flows. So when we look at total oil and product stocks, you can see surplus widened from 14.9 to 36.1. Total crude went from 21.5 to 33.4. Total oil product stockpiles went from a deficit of 6.6 to a surplus of 2.8. Now, the total crude stockpiles, that's fairly normal. Even though the rate of change is accelerating, it's still fairly normal. When you look at where we typically go until about May, we have kind of that steady increase. When you look at even last year, you can see that we're at the bottom of the cloud, but we still built. So to see builds at this point in time is not all that crazy. But when you look at total oil and product stockpiles, you can see that there's that dip that happens in February, March, April, start to see some builds. But it's the product stockpiles that we want to call attention to, because that's where you're seeing them essentially shake out. And as we had said the last couple of weeks, and again last week, was that we just weren't going to go down. We weren't going to have a normal draw. Instead, total oil product stockpiles were going to go sideways. If anything, start to tilt up a bit, just in terms of gasoline builds continuing, and then more and more middle distillate hitting the market, which is going to complicate things when you look at just storage levels and how we're going to see those builds. So Kepler put out their estimates in February. They said that OPEC crude output rose to 28.43 million barrels a day in Feb. Nigeria, they have at 1.39. Saudi Arabia held at 10.15. So again, it's not huge. A lot of this was being driven by Nigeria, but even with an increase in Nigerian flows, you're not seeing this huge, adjustment. We're still well below quota. So even though we're getting some additional product, and this Nigerian crude is going to come into the European and more importantly, the US markets, which is why we expect to see imports increase a bit, especially when you start looking at where we are on the floating side and the storage front. So when you look at land storage totals, you can see that we flipped to a surplus from negative 2.7 to 10.9. But again, it's going to bounce up and down. It's not like we're going to get this, rate of change. We should be getting builds right now. The question is going to be the rate of change and how that averages out. Land storage west of Suez, surplus widened from 13.5 to 18.3. Again, nothing too crazy here. East of Suez is where we see the biggest builds coming, and the deficit narrowed from 16.2 to 7.5, and that's where we see the east of Suez getting a bit more robust, if you will, in terms of the amount of crude that they're going to be putting into storage, especially given the concerns around some of these heat waves, i.e. India is one of the biggest ones. Over the next couple of months, they're expecting to get some massive heat waves. They want to make sure that they have coal available as well as diesel and fuel oil. So that's going to be one to watch, where you're going to see some sizable builds as they try to prepare and ensure that they have enough product for not only power gen, but also other types of generation. Floating storage surplus narrowed from 12.8 to 8. Again, just kind of flatlining. There was a re-rating with some of the data, and sometimes this happens when you look at floating storage, shipping data. And it's all about what did they turn off AIS transponders? Is it something that was kind of miscalculated? So their floating storage is a little bit higher. It's still by no means where it was in 2022, but it's just, again, it's above the 5-year average, and we don't see that changing. West of Suez, the deficit now widened from 1.8 to 4.6. A lot of that is on the back of Europe, and West Africa continues to see some steady flows. And then east of Suez, the surplus narrowed from 11.3 to 10.1. But that is actually re-rating a bit higher, still below 22, but again, still a bit elevated when we look at underlying flows. But then when we look at the U.S., you can see that we had a build of 1.16 million barrels. It was driven by Pad 2 as well as Pad 5. Pad 5 obviously being the lumpiest. Pad 3 and 4, fairly small, same with Pad 1. And then the SPR, you can see, had a very slight increase. And you might be thinking, it's like, well, why was there an increase? And it's going to be important to look at, if you remember the first iteration, or first two iterations of the quote-unquote sales from the SPR were actually lent out, which means that they have to get put back into storage with interest. So that's going to be something to balance out. You can still see we're well below the 5-year, year over year. It's not like we're going to get this huge surge. And that's just going to be the balancing that we're going to see. So we should start to see a little bit of an increase on the SPR over the next few months. And then it'll be important to see, does the DOE get Congress to cancel the remaining sales that are slated for 2023? They've already canceled them from 2024 to 2027, but they're trying to obviously cancel them as well here. So then when you look at crude in Pad 3, second highest ever, but it's relative, because when you look at just the speed in which we were already starting at a high level, and you can see that we normally get these increases. It's just they started a bit earlier, and now you're starting to see a bit of the flatlining. And there's gonna be a balancing act now, because they want to manage distillate, they want to manage gasoline. But one of the bigger issues that we're seeing, especially in Pad 3, is some of our markets are getting flooded with Russian product because it's not going into Europe. So then the question becomes, can the U.S. send more into Europe to help maintain some of these flows? And if not, you're going to see a bigger and bigger build, which is going to have to be managed. And the way you manage it is by keeping run rates or refinery throughput lower. And that's why some of these flows, when you look at some of the builds that we're seeing in refined product abroad, reverberates back and really impacts Pad 3. Europe is still an open market when you're looking at the distillate side and the diesel front, but their economic data got worse again. You saw core inflation move up, similar to the U.S., but the biggest problem that we see in Europe is just their cost. Everything is re-rating higher. You're not getting pipe gas the same way, so any new volumes are coming from LNG. You're not getting piped diesel or refined products. You're not getting piped oil the same way. So everything has to come off the water, which is inherently more expensive. So that's where you get that re-rating up. Great for the U.S. in terms of sending product, but how much are they going to take? Are they going to take the same amount that we normally send into LATAM? Europe normally sends into Africa. They're not sending into Africa because Africa is buying from Russia. So all of these situations are shifting, and everything is fluid right now. but we see this impacting the U.S. in the sense we're not going to export the same way, which is going to result in additional builds in PADD 3 and inherently put some pressure on the downside to where refinery throughput's going to go. Crude oil in Cushing, as you can see, there was another small build. But as we've been saying, the builds are going to continue, but they're just going to level off. The rate of change is slowing, and there's no reason that we see this, again, picking back up, because it's just, and by picking back up, like you can see some of these years where you had these gigantic surges, it's just going to be a steady flow because we're still pulling down from Canada. We still have a lot of crude being exported into the market. So again, there's just this constant flow, which is going, but the back and forth is going to put some additional product into storage. So now when we look at runs, runs came down 0.1. Again, went from 85.9 to 85.8. We're going to kind of hang around here just because we're getting into that peak side. As we said last week, we could get as low to 84. Maybe 83, but unlikely unless we get some sort of weather event, and we're going to bounce around at this point. We could always get some unplanned downtime because of a flaring event, but so far things are appearing to be fairly normal. And here's where when we look at normal, you see that extra little dip that normally happens. But when you look at 2022, when you look at other periods, you can see that we get that little extra dip to the downside. And we normally get it in the other years where you have that steady decline into, let's call it the second week of March. We're starting at a lower place. So we could easily see things come down, as we said, another 1.5%. They could realistically stay here. They did in 2017, where they got to this point and then just kind of went sideways, one little dip, and then they started to bring stuff back. For us, when we're looking at this, could we stay here? Sure. Based on some of the economics we're seeing, we'll likely see a little bit of a step down. But again, if we do, it's only 1.5%. Otherwise, we'll see this level staying the same. Imports dropped 119,000 barrels a day. It was all driven really by PADD 1 with a drop of 375. There was a big surge. Again, PADD 1 can be just as lumpy as PADD 5. It all depends on timing. PADD 2 had that increase that we were expecting, as we were saying, well above the 5-year average. PADD 3, again, fairly stable, and we think it'll stay stable at this point in time. Then when we look at coming into PADD 3, below the 5-year, but we just think it stays a bit above that bottom of the cloud just because of the balancing act that we continue to see and continue to expect. So that's where we think things will hold firm. You look at PADD 2, you can see that we're back above the 5-year average where we're going to stay. It'll be in the middle of the cloud. We're not going to make new seasonally adjusted highs, but there is enough to keep us above the 5-year and some of that product coming back into PADD 2. Implied demand, when you look at gasoline, so we had a big increase of 202,000 barrels a day going from 8.9 to 9.1, which is 547,000 barrels a day over the 5-year. But when you look at Gas Buddy, when you look at TomTom, when you look at all of this other data sets, it doesn't really jive with this number. So the question is, did you get a big purchase order because of weather, because of February break, and now there's going to be a big reweight to the downside? So realistically, we see this between, as we've been saying, 8.4, 8.5. Gas Buddy data, agrees with that. We're seeing TomTom also agree with that. So this is something that is a timing issue, and that's why it's important to look at some of the different flows in terms of timing. You also have the shift from winter gasoline to summer gasoline. So was some of this just people taking and buying some of the excess, winter grade prior to some of the bigger switches? Were they trying to get in front of some of the perceived price increases driven by China? Realistically, we think that there is going to be a down move. We do have some additional imports from Europe coming over. Again, this seems too high. Just as last year we said some of the numbers were too low. So but it balances out, and that's why everyone gets really angry at the EIA data, but it's like, look, it's some of it is an algorithm, but it normally nets out over time. And we look at trend, and typically you get a nice little bounce, and then that bounce fades. This one had a little bit of a follow through. Distillate had an increase of 64,000 barrels a day, still below year over year, 5 year. We don't see that changing, as we've said. Jet just coming back into our level. As we said, 1.3 was too low. 1.5 is right in that sweet spot as resid continues to stay in a steady state, with propane, propylene having a little bit of a bounce. And again, that's just back within the 5 year, but we don't see too much growth from that point. And here, when you look at the implied demand, you can see that you typically get that spike. This one came a little bit earlier, and that's where did weather drive this, because you had some delayed ordering, you had February break backfills. Realistically, we just see it dropping back towards that 10-year average, where in the near term to about 8.8, but we still have that steady state between that 8.4, 8.5 level, which we'll talk more about in the next segment. Crude oil, excluding the SPR, it's again second highest it's been, but look at where it's trending. It's trending similar to where we've been in 21, similar to where we were in 2016. So again, we don't see anything shocking one way or the other. And realistically, that's what crude prices are telling you. It's just, we're kind of here where the rate of change, you had a big move. Now you're just, the rate of change is showing some builds. It's following a similar trend that we've seen before. And we don't see that adjusting. And that's why we see this kind of this range-bound movements, which continues. So then when you look at total U.S. commercial oil storage and products, things have flatlined. That's where we continue to see some of this stability. And there will be some of that trend back up, just because we see some of those additional builds in gasoline. We still see them in distillate, which again, counter-seasonal on the distillate side. And crude is still going to see that steady movement, but that's what normally happens. We're still in this fairly normal spot when you look at commercial inventories. Supply of crude continues to be fairly stable. Not too much here. You had refined products, refiners come down a touch, a little bit of a build. So again, we're still comfortable on days of supply. Gasoline storage, as we were saying, it's going to flatline a bit, and that's where we are. We do have some additional imports coming in. That's going to help put some additional into storage, but we just see a fairly flat assessment, and that's where it looks shocking right now, where we're 14.1 million off the 5-year average, but realistically that gap's going to be closed over the next month, and that's where then all of a sudden we're going to be very normal, and that's where we think things are going to go. So the numbers will look less bullish on the gasoline side as we progress through the next few weeks, even though they look pretty good right now. That's why we caution some of this in general. Then when you look at distillate had that counter-seasonal build. It had a build of just 180,000 barrels a day. But again, you can see that typically we should be drawing. Instead, it was a lot warmer in some places, and we just don't have trucking the same way, which is why we continue to have some of these steady builds in general. Jet continues to grow. Again, it's that as distillate normalizes a bit, you're getting a bit more pushed into the jet fuel side. Not too much to see there. On the curve side, you can see we're still in some contango, but the back end is starting to soften a bit, and it's really a lot of that is driven based on expectations for the economy, as well as some of the shifts that are happening driven by the Russian flows, which is going to be an important one to watch in general. Then when you look at floating storage is at a 2023 high, which is why we do see more imports into PADD 3. We do see some of that, and a lot of that is that backlog that we've been talking about. It's still very normal for where floating storage is. It's not like we're sitting there and be like, oh, look at what's coming on shore, like we got to be careful. No, it's normal. It's a high for 2023, which is the highest it's been going back the last couple of years, but it's pretty close to where we were in 2020, which, I mean, if you think about it, we were still in a fairly normal crude market at that point. So not much to see here. It's just we do have more coming in, especially from West Africa. So that's where the thing that we're trying to get across is we're just in a very stable pricing regime. It's just going to be, what is the narrative taking it? You know, when you look at the physical markets, there's no reason to buy or sell this. It's just we're here. And, we see some of the trends getting a bit worse, especially on the gasoline front. But again, that's going to take time, and that's where we don't see too much of these adjustments. But the bigger question is going to be, which is why we want to look at Russia, why we want to look at global flows, because as that continues to ratchet up, that can create more of that pressure that we see, which is why we get a bit more cautious as we get into the summer.